Pivot, we have Team Cap X, I have Team Valor, right? I hope I got the naming right. Don't worry. I mean, I have phonetic issues, so 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 when you come here, you voice it out. I'll listen and I'll pronounce it very well the next time. So without wasting much time, I think we're about to start a competition, and I will speak out the order in which the teams will be presenting. Oh, you already have it. Okay, so we have Team Kivet starting first. Team Kivet, if you're here, you just give us a wave. Yeah, that's it. Okay, then we have. So Team Kivet will start first. I think the rest will follow in that succession. After that, I will mention the next team that will come. Okay. So Team Kivet, you are invited. The rest. The rest. Okay, so the rules of the competition is that when you are presenting, Sally, the the rest will have to go out, right? Because you don't want to be throwing your bullets out. Go, 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 go. So the team presenting is the only team that stays in, and then is subjected to a lot of questioning and everything. Then right after that, the next team. Amazing. Okay, okay, okay. But wait, sit down, sit down, sit down, sit down. You'll be going very soon, eh? You'll be going very soon. So we will communicate the order to you backstage, right? Yeah. We have a very robust algorithm that's that runs the thing, I runs the thing, I runs the thing, I then tell us this person first, this person second. Yeah, that's right. So we'll be at the even waiting for the algorithm to send me the next team that is in line, right? So like I said, give us some few minutes. I think they are trying to set your place in order so that you can go. Do you understand? This is an intellectual battle. You protect your mind. Your mind is very important. Your mind is your armor. That is what you're coming to shoot here. Do you understand? So try and you see everything counts in this world, right? That's why. How many of you have read the book on Nicole Machiavelli? You have read it. Hey, Charlie, he's the guy that you have to attack. He's the guy you have to. You see, I get you. They are snipers there inside. Oh, they have loaded their mind. They are ready for the event. You see, those are the guys you have to tap with. Charlie, you know, eat what? Watch every day down here. Oh. Make you go get, or make I go get some give you. So basically, I think you should just be relaxed. Don't be tensed, right? Be relaxed. Don't be tense. Be in the mood that you can take questions. This is not academic exercise. No one is right or wrong. The judges want to know if you can stand by your decision. If you're a decisive person, finance is all about making decisions and staying by them. No one is wrong or right, right? So basically, that's the whole thing that the competition serves. But then whilst you are presenting, have it at the back of your mind that you're not doing a local competition, right? It is a global thing. You know, you are competing with the global guys. So don't see your brother as, see him like at the top of the top. Who are the guys I'm competing with? And I think if you get that very well, you'll be able to put in your very best. Yeah, because this is just a step. This is just a step one. We are waiting for you to go very high so that you can lift the flag of Ghana high. So this is just a basic step that you have taken. So that's why I'm saying relax and don't be too hard on yourself. We want to feel the real you and give us the whole thing. So please, yeah, if you can signal when you are done, you let me know so that. Yeah. Okay, so whilst we wait for them to set up the place, I'd like to tell you a story about my CFA exams. Charlie, the thing it can humble you. It's not difficult to, but it will humble you if you feel like you did like you go school. So you can use 1 month study go clear. That one it will humble you. The thing humbled me to the extent that in my last humbling before I passed level 3, I was humble flat. You know, there's this exam you are writing in the middle of the exams, you know, waffling. Because every question you are meeting is a monster. You are searching for the small ones to give you moral boost. They are not even there. The small ones are even monsters than the big ones. So you know that in the middle, I know that the exams are blown. You see, and there's this humbling effect. When you know the exams you have blown out, when you finish writing your works, you see the way you work is different. When you know say that you are very quiet and you are very sneaky. You know, you move, you move like a detective. So that is what I did. You know, in me too, I'm very loud, so a lot of people knew me. But you see, on the CFA page, there are two me, I'm Ojim. It starts with O, right? It's pronounced Ojim. But, you know, when I came to Accra, it has to be Ojim. You know, there have to be some flair. And there was this guy, he was called Ijam. When you come, what do you call it? LinkedIn, we are that too. He's Imano Ijam, and I'm Imano Ojim. I think we all have Boachi or something. So people normally confuse Imano Ijam with Imano Ojim. Fine, I'm loud and he's equally loud. I mean, now I think so. You know, I had become quiet because successive periods of humbling means that don't be going on the page and be talking things like that. If you know your thing, you know, in my head I was dealing with my own thing. I went for this exams. I knew say I lost, so I can't bed. I wake up and my friend will call me, Charlie. As I need to feel you, and I say, what do you mean by He said, oh, but you are on the page talking that Charlie, the thing crowd, you know, finish. You take like 10 minutes. I say, me. I swear, me on the page. I went and, Charlie, it was true. You know, there was a small conversation. You were telling the guy, oh, he couldn't finish, but you think it's okay. You know, it was just like that. It wasn't like he was bragging, you know. But my friend saw the thing. My friend, we have been bombers, you know, when we bomb, we draw consolation from each other. We bomb and then, so he bomb. Where we they come now, so he was shocked that I've gone on the page to say that I did. That means this time I said, I no bomb. Where I come associate myself with. I went there and say, hey bro, Charlie, I beg you, this one there. If the thing the guy say, if the results come say, everybody go ask say, hey, Ojem, what's up? How did you? So I have to issue a disclaimer. You see, it's only CFA that will let me issue a disclaimer for people not to know that I will pass. You see, for people to not to know that I will pass, so that they don't come worry me, asking me. This competition is so real, so real. It's the only intellectual competition that is so real that I don't know what other competition can be compared to this one, because you have industry people, you have industry like practical industry people marking and grading and also presenting to them in their format, not in an academic format, in their format, in their style. So it's really prep you for the market, and we've seen people who have participated in this very competition doing extremely well in the industry, even in Ghana and outside Ghana. So it means that there's something that we are getting right here. So, I mean, as we wait for, okay, so is that, yeah. So as we wait for them to prompt us to start, I mean, you know, this. Don't worry. You see, what you are happening here is very normal in the world of finance. You see, in the world of finance, you wait for the big money managers. You get it? You are in a meeting room. Yes, and when they give you 11, they understand. They are there, but they are not in the room. You get it? It's not that they are not there. They are there. They are having their coffee. They are having their tea. They are there. But you are the one coming to ask for money, isn't you? So you don't come and defend. That is what you are coming to do. You are coming to ask them for their money. Okay, you are coming to ask for them for their money. So you have to be seated and be humble. You get it? Let's say, the time that you haven't started. Be humble, otherwise you will not get the money. Now they are finished there with their tea, and they say that you can go backstage. Team Caveat, you can stay here. Whatever you want them to buy for you, you are ready to present to them. We all listen to it. Me, I have some small money there. If I'm convinced, I'll go and buy. Or if I'm to sell, I'll make sure that I go and sell right now. So the rest, you can go backstage, and then we communicate to you which team is next. And Team Caveat, you can stay behind. And you can come forward. Let's give them a hand of applause. So if you, come. So you introduce yourself to the judges, and then can we have their slides on? If you need, how many mics do you need, or one is okay for you guys? you need 5 or you need? Okay. As many as I can take. Okay, one person will present. We don't. You see, we use one for now. So you shift it. You will take it. No, you can start with the introduction. Yeah, you can start. The presentation. Yeah, the presentation. No, that's everything. Don't be confused. Don't be tense. Don't be tense. You are here. Yes. So you are here to start your business. Introduce yourself. These are investors. Feel free. No, they are investors. They have the money. Yeah, you have the idea. They have the moolah.
So I'm the timer. You have 10 minutes from introduction to end. Thank you.
Good morning. This is Team Cavett issuing a buy recommendation for SCB Ghana. With a price target of 18.59, representing a 6% upside from the last close of 17.53. SCB is a subsidiary of the multinational SCB Group. SCB has been the longest bank in Ghana with 128 years of operation in the country. The bank has had an outstanding strive, and it was the first bank to launch the mobile bank app with 27 branches and then 68 ATMs. In the 2022 financial year, SCB's revenue was driven by net interest, trading, fees, and commission, with net interest representing 66% of the total revenue. SCB offers services in the financial markets, transaction banking, and offers retail products. Currently, SCB is trading at a PB premium of 50% compared to the industry average. SCB is more than the numbers. The company is demonstrating commitment to its environmental, social, and governance goals. The bank has been able to reduce 1.87 tons of carbon between 2022 and 2023. SCB's initiative, like the Seeing is Believing, is an initiative that tackles avoidable blindness and visual impairment. This initiative has been able to reach 5 million people. To promote corporate governance, SCB has an ABC program that promotes financial compliance within the bank's operations. Due to SCB's long existence in the country and its ESG focus, truly, SCB is here to stay.
SCB's long-standing position is not only as a result of the business model and ESG goals, the industry in which it operates in also plays a significant role. SCB ranks 8th and 10th in share of industry deposits and advances respectively. The Ghanaian banking landscape underwent significant changes, with the BOG revoking licenses of 347 out of 566 microfinance companies. And the DDP did not only cause a rise in the tensions and emotions of the general public, but it also resulted in impairment losses of 37.7 billion Ghana cedis, affecting 22 banks. With the overall health and performance of the Ghanaian banking sector, the DDP not only affected 5 times. Ghana's inflation soared to 53.6% in early 2023. However, due to the BOG's swift response to tightening measures, inflation was curbed and is projected to further drop, driving deposits and loan growth in the markets.
Utilizing the comprehensive CAMEL analysis framework for banks, SCB has exhibited a solid CAMEL performance compared to the industry average. SCB's capital adequacy ratio has increased consistently over the years, except for 2020 and for 2022 that were outliers, because in 2020 there was COVID pandemic and the domestic debt exchange program in 2022. The non-performing loans to the gross loans has also improved over the years. However, except for 2022, the rate increased due to the domestic debt exchange program, which led banks, for example, SCB, to take a more prudent approach towards their lending endeavors. Taking a deeper look into SCB's balance sheet, we notice that the loan-to-deposit ratios is decreasing. For example, in 2018, it was 33%, but moving to 2022, it stood at 25%. This is because due to the harsh economic conditions in which the bank was operating, loans became very expensive. Hence, the reason why we noticed that more of SCB's deposits were going into investment securities. For instance, the Bank of Ghana interest rate rose up to the 30%, which is the highest seen in the past years. The financial ratios for profitability shows that the revenue has been increasing significantly, except for 2022, which has been an outlier and can be reflected in the return on equity and return on assets as seen from here. So, based on this, SCB's strong financial metrics prepares SCB for continuous growth in the industry.
To reiterate the point made earlier by my colleague, we issue a buy recommendation for SCB with a target price of 18.56 Ghana cedis and a premium of 6.05%. This was driven by their proven financial excellent record, their economic moat and technological moat, which we believe will anchor the bank into coming out of the red into a bullish run. Taking the proven financial track record of SCB, we realized that SCB had made good returns as seen in the upward trend in dividends and earnings per share. The bank also boasts of a high CAGR of 14% in net profits from 2012 to 2021. With this being said, we project that there will be a good earnings outlook for the bank, which will put the management in a good mind space or head space to increase dividend payout. Moving on to the economic moat, we have over the 128 years of SCB operating within the industry, they have been able to build a good brand reputation with their corporate clients, making them a market leader in the consumer experience within their country, making it undeniable that they are positioned well in the market. Moving on to the technological moat, it's undeniable that our world today is driven by technology. And with this being said, SCB's technological moat serves as an asset to the bank in terms of in the Ghanaian context and internationally, as SCB has outperformed its competitors within the technological space, with reference to them winning consecutive awards in terms of digital banking and mobile banking over the years. We believe this will help SCB be able to reflect or unlock the true share price of the company.
Moving on to the valuation, we use 3 different valuation methodologies to arrive at our share price.
3 minutes more.
Implied share price of 80.59 Ghana cedi, which is upside of 6.05% to the last close of 70.53. The 3 methodologies we used are the DDM model, the PE and the PB ratio, which is under the relative valuation model, and the residual income model. With a cost of equity of 24% and a terminal growth rate of 3.7%, we arrived at an implied share price under our DDM model of 18 cedis and 1 peso, is an upside of 2.74%. Flexing our 2 key variables in the sensitivity analysis, we arrived at a bull price of 20.23 Ghana cedis and a bear price of 16.19 Ghana cedis. Moving on to the relative valuation, we use the PE and PB multiples to value SCB. We decided to use this spreadsheet because it's difficult to calculate the enterprise values of banks due to the difficulty in ascertaining what debt means to the bank. We adjusted the PE and PB multiples using the historical premium at which SCB trades to HPS. Using adjusted PB multiple of 1.9x and adjusted PE multiple of 4.2x, we are at an implied share price of 19.81 Ghana cedis For our PB multiple, represent an upside of 13.01% and 6.8% for our PE multiple. Our upside of 13.01% for the PB multiple was the highest among all our valuation models. So for our resident income model, we awarded the highest rate of 50% to our resident income model to reflect SCB's history of stable and predictable earnings, and thus emphasize its ability to generate long-term shareholder value. Using the resident income model, we arrived at a target price of 18.16 Ghana cedis, which is an upside of 3.61%. So it's 50% weight for our resident income model, 20% each for our PB and PE multiples, and 10% for our dividend discount model. We arrived at our target price, driving our buy recommendation of 18.59 Ghana cedis, which is an upside of 6.05%. We conducted a scenario analysis flexing our major assumptions for our forecast. This is a deposit and loan growth, net interest margin, and cost to income ratio. We arrived at an upside of 20.61 for our bull case scenario and a downside of 21.56% for our bear case scenario.
As a bank, SCB is faced with various investment risks that might affect our valuation, with the key ones highlighted in the slide. For the technology, we suggest that SCB should implement a robust cybersecurity system to detect any threats in their systems. Moving on to the mobile money, we encourage SCB to collaborate with key telecom companies such as MTN to solidify their space in the market.
Right, we should be running out.
Going nowhere, SCB is here for good. Once again, we recommend a buy recommendation for SCB with a target price of 18.59 Ghana cedis and an upside of 6.05%, driven by these three factors: the proven track record of financial excellence, economic moat, and technological moat. And to our investors that are worried about the current fluctuations in SCB's current market price, fear not, SCB is here for good.
Hi, hello, can you hear me? Perfect. Is that it?
Yes, income rate.
Okay, well done. Maybe if you can take, you said you had a specific revenue projection. Can you walk us through what led to your revenue assumptions?
What led to? Yes. Okay.
We'll have to click on the appendix to go to the link of the document.
So for our forecast, we have forecasted a growth in deposits from 13% to 12% over the forecast period. So we forecast a drop in deposits as consumers seek alternative means of like investing their money instead of just putting it in their bags due to alternative means of investment. So that's our focus. And then for our loan growth, we use the historical GLAE, that's the gross loans and advances growth rate to grow our loans over the forecast period. And for our operating expenses, we use the cost to income ratio to forecast our operating expenses. For our net interest income, we use the net interest margin to forecast our net interest income. And then that's
Okay, sure. Okay, so do you know that the 9 months results are out?
Yes, please.
Did you consider it at all?
Yes, please.
So
we forecasted for the fourth quarter, looking at the trend over the 3 quarters to end the year. So that's what we use, and then we forecasted based on that for the rest of the forecast period.
So your deposit growth rate, for instance, tie in with the 9
With the 9 months, yes, please.
First of all, thanks for the presentation. This is the first slide. You're recommending that we buy SCB, but the upside is 6%. In a country where the inflation is about 20%. How do you square that?
So Based on the projections, it's showing that the interest rate, the inflation rate in Ghana is going to continuously reduce. This has been seen from the performance or the trend starting from 2022 that has been decreasing significantly. Also, the new policies that are being implemented by the Bank of Ghana, and also the recent budget reading shows the various measures that the government was putting in place to make sure that the rate is reduced. The Bank of Ghana is implementing very strong monetary policy rates to ensure that the economy is more stabilized. So if these policies are well implemented, we expect that this will reflect into our projections for the upside.
I think that has been a trend for like over the historical period. Like the net interest margin contributes a larger portion of their income. So I think based on their track record, we know they've been able to maintain this percentage of revenue from the net interest, which we believe like to continue over the forecast period.
To add to what my colleague said, over the past 5 years, their debt interest has contributed to more than 50% of their total revenue. Hence, we used it to help project our valuation.
Also, because we are projecting that inflation is going to go down, it means that loans are, and also the Bank of Ghana rate is also projected to go down. It means that loans are going to become very cheap and more people are going to be coming for loans in the bank. Hence, we are assured that the bank will continue to get loans and they'll be able to make interest income from the difference. Okay, so when I was explaining it, first of all, I spoke about the capital adequacy ratio. So basically, this ratio shows the amount of the bank's capital that can absorb the risk assets of the bank. So over the year, SCB's capital adequacy ratio has increased, which is good, except for 2020, which we have explained that was due to the COVID. So in supporting our buy recommendation, this means that SCB has enough capital to be able to cover up all risks. For example, if you look at the case of the the bank that went bankrupt or went down, is because they do not have enough assets to be able to cover up for that. So SCB is well positioned to stand against any kind of possible risks that might affect it. And also, when we talk about the non-performing loans, I mentioned that it reduced, meaning that these are the loans that they might become possible bad debts for the bank. So if they are actually reducing, means that SCB is going to make returns from the loans that they are giving out. So it's actually good for them to reduce their non-performing loans. Yeah.
So the price to book was part of our valuation, but the loan to deposit ratio, like she said earlier, there's been a consistent decline in the number of, or the loan to deposit ratio, which means that a lot of its assets or its deposits are going to investment security rather than to loans. I think she gave a reason that due to the current outlook, macroeconomic outlook of the country, loans are more expensive, with interest rate being at an all-time high, making loans expensive. So the next best alternative for most of the banks, including SCB, is to invest in government securities to be able to make returns for their shareholders.
expecting robust growth in net interest income. Can you reconcile the two?
I think it goes hand in hand. So the interest. Okay. So just because we had three drivers of revenue, which was the net interest margin, fees and commission, and then trading income. So we forecasted each of them separately, to be able to get the full revenue for SCB over the forecast period. So you want me to, can you come again with the question?
So my question is, you expect interest rates to decline. How do you reconcile that with your robust plan?
Okay, so it's net interest margin. So the margin, the interest rates that they pay on their deposit versus what they pay on their loans. So with interest rates falling, which means the interest that they pay on their deposits will also fall as well, which will kind of cancel out, and then it's
Your cost of funds was like less than 5%, right?
cost of
Yeah.
funds.
So your net interest margin, the reduction in cost of funds is likely to be small compared to the reduction in interest income.
I think I quite.
So, to clarify with the question they're asking, how would that reflect into the banks, like the reduction in interest rate, how is that going to reflect in SCB? So, and also linking it to our net interest income. So if the Bank of Ghana interest rate reduces, it means that banks will be able to offer cheaper loans to people. And if these cheaper loans are offered to people, they'll be able to make more profit, because then if the loans, people will come to borrow more, and then the difference between the deposits and the interest from the loans is going to actually increase it, which supports our buy recommendation.
Yep.
I don't quite get the question. Mhm. Yes. Mm. Yeah, I mean, I think the increase I think happened yesterday or just 2 days ago, and we had finished everything already. So that was when it was 17. That's why it was the last close of 17.53. So I mean, yes. Also, yes. I think it still has legs to go a bit more high, because the historical, the 52-week high was around 20.62 in the about. So think even though like they pay dividends consistently, due to the DDP, we know they make those systems able to pay into. In 2017 too, they did not pay dividends they didn't give really any justifications for not paying. They just did not, the directors did not recommend paying dividends. So due to those two factors, we realized that there were some inconsistencies in dividend payments. So we awarded the rate of 10% to DDM models.
Okay, so we factored the possible restructuring of the government debt. For one of our slides, if you saw for the industrial analysis, we spoke about the original domestic debt, and then we also spoke about the revised domestic debt exchange rate, which showed the various variations that could affect or the impairment losses that could accrue to SCB. So if the government adjusts the debt and in a positive way, it's actually going to favor SCB because more of their investment securities are in government bonds. But if the government does it in such a way that it would disfavor SCB, that is going to affect them. That is why for one of our valuation investment mitigations, we advise that they should apply a robust credit assessment for all their investments because they have already been hit hard by the domestic debt exchange program. The finance minister said the head cuts will not affect treasury bills, so in that case, it's not going to affect it. So we believe that SCB's treasury bills are safe.
You may have mentioned this, but can you explain again why you weighted residual income 50%?
I mentioned it earlier about using awarding 50% to reflect the historical and stable earnings of SCB. So I think the resident income model is based on the premise that the resident income model factors in cost of equity into its valuation and also considers the long-term performance of the firm or the future projections of the firm. So looking at the assumptions that go into the resident income, we felt it will best reflect the assumptions that we made for our valuation, for our forecast. That's why we awarded the highest rate of 50% to reflect the history of stable and predictable earnings and also the outlook for the company.
Can you walk us through how you arrived at your cost of equity?
Okay, so we realized that using the CAPM model, our beta was negative because the average return on the market over the last 3 years that we used was the excess return on the market was negative, which affected our beta, and we couldn't use the negative beta in our CAPM model because it will result in the wrong valuation. So we decided to use the bond yield plus method, where we picked the 5-year government bond yield plus the equity risk premium of Ghana using the Damodaran equity risk premium reports. Yeah, so we average, because we realized that the last year's value was quite high, so we averaged it over the last 5 years to get an average equity risk premium for Ghana, and then add it to their bond yield to get our cost of equity.
Just a comment, okay? In your presentation, try to be a bit more specific. You kept using
Thank you very much. So we wait for the next team, and the team is, in fact, they know themselves, so they are coming. Don't worry. I have to search because the algorithm just sent it to me. Yes. So team capital curators. Team capital curators. Let's give them a hand of applause. So you have 10 minutes for the presentation and 10 minutes for the judges to ask you a question. You can commence.
Good morning, ladies and gentlemen. Today we explore Standard Chartered Ghana, a company whose tagline speaks volumes, here for good. We initiate coverage for SCB Ghana with a buy recommendation based on a 12-month price target of 18.96 Ghana cedis based on a residual income model, relative valuation methodology, and dividend discount models, implying an upside of 8.15%. I recommend... Our recommendation is based on 1. The bank's championing digital innovation, driving higher competitive advantage. 2. Strong balance and favorable margins, maximizing shareholder returns. And finally, customer commitment and strategic agility, unlocking earnings potential. SCB was formerly known as Bank of British West Africa, which was founded in 1896, and since its foundation, it was listed on the stock exchange in 1991. Through the leadership of Mansanete, the bank has experienced great resilience and innovation. The bank currently has 3 main business segments, which are corporate, commercial, and institutional banking, consumer, private, and business banking, and wealth management. It is worth noting that SCB is a pioneer in the digital banking space, as SC Mobile has been awarded the best banking app for 6 consecutive years.
Moving on, we'll discuss the industry and how SCB has demonstrated strategic resilience by navigating through the turbulence of Ghana's banking sector. We analyzed the industry based on Porter's 5 Forces framework. Now, since 2018, the industry has undergone significant transformation from the banking sector cleanup in 2018 to the DDEP in 2022, which resulted in affected banks having to recognize significant impairment losses. Also, there was the COVID-19 pandemic, increased inflation rate, changes in capital requirements, and the entrance of new competitors as a result of the adoption of mobile money in the country. These significantly impacted the sector. However, amidst all of these challenges, the industry has grown robustly at a 23% average. Also, the number of bank account holders, has increased drastically, with the industry deposits increasing by 27% from 2018 to 2022 averagely. SCB, being one of the top 10 banks in the industry, along with GCB and EcoBank, also a growth in their deposits, with SCB recording an average growth rate of 17% from 2018 to 2022. Now, one key driver of this growth is the increase in internet and mobile banking in the country, technology to enhance its offerings and customer experience. As a pace setter in the sector, it was the first to introduce SMS and online banking in the country, demonstrating its adaptability and foresight to evolving customer needs. With initiatives like these and the growth that the bank is seeing, it is definitely true that SCB is here for good.
Now, what about the ESG? With environmental factors, Standard Chartered Bank has demonstrated a commitment to environmental stewardship. This is evidenced in their tree planting project, where they planted 1,250 trees at Ramsar site during their 125th anniversary. In the realm of social consideration, the bank is a dedicated one, considering the lives of the people they serve, to prove programs. These include blood donation exercises and spending time with special kids. In terms of governance, the bank has a structured board with Standard Chartered PLC being the
than what is expected of them, have a strong balance sheet and have enough reserves to cover potential losses. SCB showed strong asset quality with regards to non-performing loans, as the ratio fell from 25.16% in 2018 to 12.04% in 2022, showing lower credit-related losses. In comparison with the peers, as you can see, the historical industry average is 15.36, much higher than SCB's value in 2022, showing that they are better than their peers and have a stronger asset quality. In terms of management, SCB have a diverse portfolio of managers with 20 plus years in international finance, holding senior management positions in MTN Ghana, SCB Nigeria, Unilever, and more, which promotes financial resilience as they can use their leadership skills to effectively incorporate SCB's policy and push for continuous progression. SCB recorded bullish trends in the return on equity and return on assets. The return on assets grew, as you can see, from 20.1 to 26.6%, much higher than the industry average of 19.05. This shows that they're stronger in the return on equity than their competitors. The return on assets was constantly 4%, but peaked in 2020 at a value of 6%, much higher than the industry average of 2.9%. In terms of liquidity, SCB had a higher liquidity ratio in terms of their liquid funds per total deposits of 90% across all 5 years, peaking in 2021 at 99%, much higher than the industry average of 87.6%.
Okay, so moving on to the valuation. SCB was valued at a share price of 18.96, representing an 8.15 upside to the 1-month VWAP of 17.53. To calculate this valuation, we conducted a blended valuation methodology consisting of the residual income model, which had a weight of 40% due to SCB's price being driven by external market factors such as its high ROE. We also conducted a dividend discount model, which had a weight of 30% because SCB is a dividend-oriented bank. Also, to not downplay the weight of the banking sector, we gave the relative valuation a weight of 30%. For our relative valuation, our peers consisted of all the publicly listed banks on the GSE, and we used adjusted multiples as SCB, as clearly shown on the graph, has higher PBs and PE compared to their peers. Our relative income model resulted in a share price of 19.41, with our DDM resulting in a share price of 18.33, and our relative valuation resulting in a weighted share price of 18.98. To test the validity of our valuation, we conducted a scenario analysis to confirm how SCB's price would compare when it comes into when market conditions come into play. For this, we tested it using income rates, expenses, deposit growth, and terminal growth. As shown, the bear case resulted in a share price of 15.71, with the bull case resulting in a share price of 22.31. We further conducted a multi-color simulation for our residual income model by stressing on the cost of equity, operating expenses, interest income rates, and deposit growth. As shown by this graph, 83% of our 1,000 trial multi-color simulation resulted in a share price above the 17.3 mark, further buttressing our buy recommendation.
We identified 3 key downside risks to our buy recommendation, being technology risk, credit risk, and competition risk. Technology risk questions whether SCB will keep up with digital banking trends and cybersecurity threats. This would increase their cybersecurity and technological expenses. SCB can, however, mitigate this by investing more in technology. There's also credit risk, which is a risk that looks at whether people can default on loans, which is very high. The potential for default on loans is very high due to Ghana's current economical challenges. This will, even though SCB do very well in the non-performing loans ratio, this will actually increase the ratio. However, SCB can mitigate this by investing more in credit risk management. The last is competition risk, which looks at individuals trying to erode SCB's market share. This would cause a drop in their revenue and their profitability. However, SCB can mitigate this by investing more in customer relationship management.
Ladies and gentlemen, SCB is charting a bright tomorrow through digital information, strong and favorable margins, and a strategic agility. We recommend a strong buy based on a 12-month target price of 18 Ghana cedis, 96 pesos, with an upside of 8.15% as at 31st January 2024. Don't forget, we are capital curators. Thank you.
Capital curators.
Before I start with my questions, I would like to make a few comments on your presentation, most especially because you may be representing Ghana on the world stage. Okay, so excluding this moratorium, STB has clearly shown that they were consistent with the dividends, excluding, not factoring in the regulations which would play for not too long. We are sure that SCB would continue to gain capital gains, which as seen by yesterday, the share price was 19.25, representing a 9.66 upside already from the 17.53. So even excluding dividends alone, SCB has returns, which shows that even without them having DDM for now, there is the prospect that they would pay it in the future, given their previous track record, and there's also the room for capital gains. Up to 2028, so 5 years. Yes, please. Exactly. Would you want me to move to that? Okay, so the cost of equity is 21. So our valuation was very modest, as we didn't want to overstate how much SCB would do over the next 5 years. Given that we reduced deposit growth to 10% instead of the 17.98 which SCB recorded, this would definitely play into reducing our revenue, net interest income, among many other factors, including the valuation price. Based on this alone, based on their track record alone, as shown, they've already gained almost 10% in 2 months, far surpassing the 5.4 you mentioned. As such, we still believe that SCB is still a strong buy.
If you don't mind, to add on to what he said, your question is basically about why you should invest in SCB. We think that it's best because, as mentioned before, SCB consistently pay dividends, and as an investor, that's what you want to retain more, dividend payments. Additionally, even the price of SCB even rose this month, showing that us saying that we should buy is actually backing per real life events. And this is because of earnings announcements by the global reports coming out. So speculation about that is what will make people want to buy more, and that's what increases the price. So the fact that if you buy now and the announcements come out and the price even increase, you make that profit from it.
Finally, okay. Yes, please. Finally, through our research, we found that the GSE has projected that the growth on the markets would be around 15 to 20%. So since SCB has already started growing, as you can see from, was it yesterday's price? Yesterday's price, we are confident that within the period of 2024, SCB will continue to rise in its share price and over time to go further. We are yet to. Yes, please.
So the 19 was the industry average. SCB was SCB's ROE is about, if you don't mind me showing. So okay, sorry. Yeah, so the ROE was around 20%. I'm just looking for, but above 20%. So as you can see here, the ROE in 2022 was 26.6%.
One of the key drivers of your valuation is the digital story. How exactly is that feeding into your forecast?
Okay, so just as we mentioned, there is increase in mobile phone users. There is increase in internet and online banking services, and so this is showing in the increase in deposits of SCB. So SCB has a good app that is utilized by customers, right? And so that feeds in to the increase in their deposits. Right. Okay.
So to add on, as you mentioned, SCB is being driven by their digital innovation. Quite recently, SCB launched a means by which you can register for a bank account without even having to see the bank, just with an online application. This implies that they would have increased deposits, which would feed into their revenue, obviously. So they would have an increased revenue, which would then mean that there's more to gain for investors. As such, they have a brighter prospect in terms of how much investors can gain in terms of dividend as well as capital gains.
So if that's the case, why did you drop the dividend growth forecast compared to the historicals?
You said?
The percentage growth in dividend.
Okay. So the recent dividend in
For your forecast period is 10%.
Yes, please.
Historical is about 17.
Let me get to that. So for
Sorry, I meant deposits.
Yes,
Yeah.
I'll get to that. So for 2022, it was actually 6%. But then with 2019 and 2021 being harsh outliers of above 20%, as such, the 10% is not particularly a downsize, but then it's an increase from the 6%. But then factoring in the previous 4 years, the 10% looks like a downside. Yes, so generally, we will expect it to grow at a stable rate of 10% all across, which, as shown on the graph, still results in profits for the firm.
Okay, so let me rephrase my question. You expect the digital strategy to rake in a lot of deposits, yet you have dropped the historical growth rate in deposits. Why?
Okay, so now I have a clearer understanding of the question. Good. So despite SCB having a digital app, there's also the rise of fintech firms in Ghana, with the rise of G-Money, EasyPay, all those ones. There are more that come daily, which will clearly feed into our investment risk for competition, where they erode the market share and decrease the deposits for SCB. As such, it is fair that we reduce it to 10% instead of outblowing it to about 25%, which would not probably happen, being the Ghanaian market is very competitive, and that most Ghanaians are always looking for new ways to save their money, factoring in interest.
If I may add on, yes. So I just want to say that in addition to what he said about the competition with fintech firms, it's also the fact that in Ghana's current economical crisis, there's lower disposable income for individuals, for investors. The fact that the people will want to put money aside for things that actually, like survival stuff that matter. So there's less money that people use to invest into stocks. So that's why there'll be lower deposits, because we have to grow at a modest rate.
Okay, so a short one, a conclusion.
Yeah, I was going to ask, so in 2022, what was the growth rate for the industry? Yeah, I think you may have mentioned it.
Okay, so just like how my colleague said, just yesterday, or the current news says that they've increase the limit of amount of money you can have in your Momo account. So instead of me going to the bank or having a long process to apply and then have my deposits in the bank account, why not? I can save as many as money in my Momo account. So that can also decrease the deficit.
But do you know that the Momo floats end up in a bank account?
Yes.
Okay. My last question. So you showed a very high liquid fund to total deposits ratio, and then also a very high capital adequacy ratio. Do you think the bank is sweating its assets enough?
Sorry to clarify.
Sweating its capital enough.
When you say sweating, please, what do you?
Yes, please. Generally, SCB is very conservative in terms of investments, given that they try to hedge risk. But then, being that they do invest in foreign securities, SCB does, in the perspective to other banks, they do keep an optimal cash flow to be enough to remain liquid. So they do invest in short-term assets, which means they do sweat it, but it's still liquid enough that when they need it, when they are run on banks, they can still convert it easily and whilst gaining their returns for their investors.
I'll be curious to see what your forecast for net interest income looks like.
Let me go to that slide for you. It's in our appendix, so it might take a while. Okay, so as you can see, net interest income per forecasted year for 2023 was quite high at 1 million, at least here, excluding the. Okay, sure. Let's do that. So for the assumption.
So, yes, so with our assumptions, we identified that net interest income is actually like a key driver in SCB's revenue. The net interest income is basically, I'm sure as you know, the difference between the interest income and the interest expenses. The interest income being stuff such as the loans and the deposits from the customers. The expenses being such as things like loans from banks. So it's based on this that we had an interest expense rate of 3% and 10% being for the sum of cash and cash equivalents based on our cash flow statements and the historical figures.
Okay, so just a comment. There are some standard ratios that you would typically see in forecasts. So for instance, loans would typically be projected based on a loan deposit ratio and things like that. I don't see that because you are likely to move to represent Ghana on the world stage. I thought I should mention it. But you didn't use it for your forecast. Did you use it for your forecast? Yeah, but that's not the core assumption that fed into your forecast. Thank you.
Thank you.
Thank you very, very much. I think without wasting time, we will welcome the next team, which is Team Cup X. So we will Team Cup X. Cup. stand there. So you okay? So you point the projector to the slides. Yeah. If you want it to move. Okay. So the pointer. So sorry. Yeah. You can point there. You see, you have to look at it. And it's a high tech, but with a little touch of appropriate technology. You know, how many of you did Aprotech? Okay, okay. So you introduce yourself to us, and then you let us know why you're here, what you're doing, and then you can pick it up from there. So, ladies and gentlemen, this team Cap X, right? Sure. Thank you.
Good morning. This is Team Cap X with me, Benedicta, and my colleagues, Emanuela, Majorin, Oscar, and Kevin. So we are here to analyze Standard Chartered Bank's investments. Thank you. So I'm starting with the business description. Standard Chartered Bank is headquartered in Accra, Ghana, and has history dating back to its establishment in 1896. So over the years, Standard Chartered Bank has contributed greatly to the financial landscape of the country and has been listed on the Ghana Stock Exchange since August 23, 1991. Standard Chartered Holdings currently has the highest company share with a 69.42%, followed by SNIT with a 14.55%, highlighting the company's strong ownership structure. So Standard Chartered Bank works under various sectors, serving clients, retail, commercial, and corporate clients. Thank you.
I'm Majorin, and I'll be continuing with the industry overview. So the banking industry in Ghana is regulated by the Bank of Ghana, and it comprises over 23 licensed universal banks, both the international and then the local players. The industry has a high rivalry among the ROA, and then their market share. Standard Chartered Bank has a market capitalization of 2.36 billion Ghana cedis, which makes them the highest in the industry, and it gives them a strong brand and reputation and opportunities of growing demand for digital banking services. Thank you.
My name is Kevin, and I will be taking you through the valuation analysis and investment summary. Now, with our valuation analysis, we're able to employ two models. That is the market valuation approach and the relative valuation approach. Now, we use the market valuation approach to analyze the position of Standard Chartered Bank on the Ghana financial market based on their asset value. So, per analysis, by the time we're doing our analysis, the book value of Standard Chartered Bank was expected to increase by a margin of 33.6% by the end of 2024. Based on this analysis, we also realized that the book value per share of Standard Chartered Bank was also expected to increase by the same margin, provided that there are no increase in their outstanding shares. Also, the price to earnings of Standard Chartered Bank currently stood at 6.59 Ghana cedis, indicating that there's a high room for profitability and growth into the future. Also, we're able to get the price to earning growth rate of Standard Chartered Bank, and their price to earning growth rate is expected to be at a margin of 33.5%. The earnings per share of Standard Chartered Bank currently is a positive figure of 2.66 Ghana cedis, and it is also expected to increase to a margin of 3.16% in the near future. Now, with our relative valuation, we made a comparable analysis with SCB and other selected banks within the institution. Based on our analysis, we realized that Standard Chartered Bank currently has the highest market capitalization among all the selected banks within the industry, indicating that they are the safest institution you can actually invest your stocks with. This is because they have a long history of financial good performance over the years and dating back to since their establishment. Also, looking at the stock price growth potential of Standard Chartered Bank and other selected banks, we can see that SCB currently has the highest growth potential. If you buy their stocks now, we are likely to increase their stock amount in the near future by a margin of 18.7%. Also, they are operating with a very high ROE and ROA margin, indicating how efficiently they are utilizing their shareholders' equity and their assets in generating profits. Now, based on this analysis that we made, we issue a buy recommendation on Standard Chartered Bank. This is because, one, the asset analysis, the price of Standard Chartered Bank stood at 17.53 Ghana cedis, and we were able to forecast that the target price of Standard Chartered Bank by 2024 ending is expected to hit 20.81 Ghana cedis, indicating an 18.7% growth rate. This also shows that if you are an investor and you are to buy SCB stock currently, you are going to increase your share weight by a margin of 18.7% the year end. Also, we are able to analyze some key drivers, having an earnings per share amount that is positive as at now, which is 2.66 Ghana cedis from the previous loss that they were able to, from the previous loss they made in 2022, which is negative 2.21, indicates how strong they are in their profitability management. Also, having a positive price to earning ratio indicates that they have a room for more profitability in the near future.
And based on this, we were able to forecast and see into the future that the ROE increased to 100 is expected to increase to 42.3% in 2028. Looking at the asset quality into the loan loss coverage ratio. So per our analysis from 2018 to 2021, there was some, but in 2022, this ratio increased, and based on this, we were able to forecast and see that for the next 5 years, this ratio is going to increase. Looking at the management quality, so for the past 5 years, Chat has been able to maintain its cost beneath the industry average. For instance, cost to income ratio of Stanchart was below the industry average of 46%. And with this, we're able to forecast for the next 5 years that this trend is going to flow. So, this does this mean? Income spent by the bank to cover its operating expenses. Let's look at the liquidity. So, from 2018 to 2020, from 2018 to 2022, the liquidity ratio. 2023, the bank recorded a high liquidity ratio, showing that its short-term obligations. And based on this, we were able to forecast into the future that for the next 5 years, this liquidity ratio is going to increase to 106.9.
So to our buy recommendation, we identify some risks. So credit risks. So the credit risks is being managed by Stanchart, as the bank recorded low non-performing loans in 2021 and 2022, showing the bank's dedication to tackle credit risks and improve on its loan portfolio. Interest rate risks. So net interest margin remains stable, as the bank has put in measures to effectively manage interest rate risks. Exchange rate risks. So fluctuations in the exchange rates can influence the profitability of the bank's transactions. As a result of this, the bank has put in framework such as using derivatives to offset potential losses from exchange rates and ensure stability. Liquidity risks. So based on our analysis, we realized that the SCB maintained a moderate liquidity position. As a result of this, it was observed that the liquidity risk appears to be very low, as the bank has demonstrated resilience to liquidity shocks and has maintained liquidity coverage ratio above regulatory requirements, ensuring that there are enough liquid assets to cover for its short-term funding needs. Thank you.
My name is Francis Oscar. I'll be presenting on ESG. Standard Chartered Bank Ghana, being the oldest in Ghana, has a long understanding commitment when it comes to ESG. Let's look at the environmental aspect when it comes to ESG. Standard Chartered Bank Ghana impact the environment. Some of their partnership or their impact books, they were able to engage in afforestation projects and have planted 3,700 trees in partnership with friends from Ramsar to improve our climate condition. The social. Over the course of 5 years, the GLOW initiative empower young girls, their skills, knowledge, and the confidence they need to become leaders in the country. The GLOW impacted 10 young girls aged 10 to 18 years who are living in underserved communities in Greater Accra and Eastern Region. Hello. Governance. The bank also emphasizes on gender diversity and inclusion. At the end of the financial year 2022, the bank made a steady 40% of women in senior position.
Analysis to come up with these basic findings about SCB. They have a sound financial position. They have a stable price that is supported by macro factors. They have an increase in operational efficiency. They have an upside growth potential of 18.7% and a positive earnings per share, which is currently standing at 2.66 Ghana cedi. Based on this analysis that we have conducted, my team and I conclude that it is a buy recommendation of Standard Chartered Bank. Thank you.
Okay, maybe I'll make a general comment and then my colleagues can come in. The flow of the slides wasn't that great. Usually you would want your analysis to flow into the valuation. Okay, so that's something to consider.
Well, just on the lighter side, gentlemen, have you sat in a trotro, as we say? I mean, you reminded me of a preacher man in a trotro. The energy was infectious. I'm not sure I followed the analysis leading to your conclusion, even though I think your conclusion kind of ties in with your upside, even though I really couldn't follow what's at that. And this is just a general comment on ESG. It's a new buzzword, and maybe
Okay, so we focus more of our analysis on the future because investors are mainly focused on what they are yet to receive. Okay, so we're able to analyze the historical trends. So this was the analysis that we made. So we used a model to predict our forecasted values. That is the ARIMA model, which explains as autoregressive integrated moving average, whereby it analyzes historical trends and then by these trends it's able to predict into the future. So we analyze the historical trends and we're able to predict the values into the future. Thank you.
So in your forecast, did you consider the historicals? Did you look at the interrelationship between various line items on the balance sheet and things like that?
Yes, please. That's what we did.
Yes, we considered that. So we considered the percentage growth, let's say with the rates, using the historicals to predict for the next 5 years. Yeah.
So for all the line items that you forecasted, you consider the historicals
Yes,
and
please.
then based on that.
Yeah.
So usually there are some interrelationship between items on the balance sheet and income statements. Okay. So for instance, for a bank, if you take the interest income, it will be linked to earning assets, for instance. So those interrelationships are also critical in your forecast. Okay. Did you only use price to book for your analysis because you said you used relative valuation and market models, but they're actually the same thing. So I was a bit confused.
Okay, so
And you didn't consider any like DDM, like cash flow models, like dividend discount model, residual income free cash flow model.
okay, so during our analysis, as you rightly said, we use the market valuation approach and the relative valuation approach. Now, the market valuation approach was utilized to understand HCB. Then after that, we use the relative approach to also undertake a study for other selected banks and then compare it with HCD and see their performance. Based on that, we're able to make our conclusion on Standard Chartered Bank.
That's it. It's the same model. Okay. Yeah. So it's something like a two-stage, but it's the same model. So you use one model for your analysis.
Please, we didn't consider the cash flow because when it comes to bank, it's different from other companies. For instance, it's very difficult to predict their cash flow. Let's say assets, loans, their assets. It's very difficult. It's very difficult for you to predict the cash flows from their loans. Thank you.
Yeah, but you can still use DDM. So I understand what you are saying. Even that there are a lot of works that has been done by different people trying to use even free cash flow to equity, which is typically viewed as a problematic one, to value banks, right? But then apart from that, there are other models that you could have used. Okay, so if you are using one model, you should have a very strong reason why you are using that, and I'm not getting it.
Okay, so our reason for using the market valuation approach is because we wanted to understand the worth of SCB on the financial market. So we're comparing their financial books relating to what is actually expected on the market. So we're actually comparing SCB's financials to what is actually happening within the industry. And that is why we're more focused on the market approach.
Okay, thank you. I mean, I think my concerns tie in with what Anas just said. So if you are telling us that you are focusing strictly on the relative valuation models, you must give us a compelling reason why you're using that. Or in another way, you should be able to discount the other methods. You should tell us why you are not using the free cash flow models, or you're not using the dividend discounts model, for instance. Okay, all right. But I mean, in general, I mean, it was a very strong presentation. The energy was there, and then you actually presented. You took us through what you were doing, but your slides were quite busy. On one of the slides, I saw that the table of contents was on the same page as one of the items, the business description. Please watch that as you progress. All right. Thank you very much.
Thank you, sir.
Did you do, I didn't see an industry analysis, apart from what you used for your relative valuation, I think. Did you really do like an analysis of the industry, the banking industry? I don't remember seeing that.
Yes, that was the second section we presented on.
Okay. You did that. All right. I might have missed that. Thank you very much.
Hello everyone, this is Macroboard Advisory. I'm Lois Boy, a team member of Macroboard.
I'm Comfort Etiahene, team member of Macroboard.
I am Isaac Edu, team member for Macroboard. I'm Prince Asamoah Osu, and I'm also a team member of Macro Board.
I'm Wintigo Prosper, team member of Macro Board.
Good day, everyone. We are from Macro Board Advisory, and we are providing coverage on the banking industry, specifically Standard Chartered Bank, SCB as it's known on the Ghana Stock Exchange, with buy recommendation, employing 3 valuation methods: residual income model, dividend discount model, and relative valuation model. We ended up 7 and 18.36% upside. 3 key things drive our recommendation. As such, SCB is a global university space. It has 3 sources of revenue: interest income from loans and advances, non-interest, the services they provide, and trading income from treasury and capital market activities. As of third quarter 2023, interest income is seen to be the largest driver of revenue, contributing 69% of revenue. Now, aside from that, SCB employs 2 business models: corporate, commercial, and institutional banking, known as CCIB, targeted at high corporate and institutions. Also, they have another model called the consumer, private, and business banking, targeted at medium business and high net worth individuals. As of the last financial year, CCIB is known to be the largest driver of revenue. Now, moving on to the market and economic analysis.
How strong industry? Ghana's successful debt restructuring negotiations has contributed to financial stability. With the country's GDP growth rate currently 2.7% and inflation about 15% according to IMF, there is an indication of a relatively stable economy for SCB's operation. Now, to the market indices, it shows that SCB outperforms the market with a 40.4% share from its lowest of 12 cedis 50 pesos in May 2023, as against the composite and financial of 25% and 13% respectively. Now, within the industry, SCB holds a competitive position with a fair share in its deposit. Moreover, in the third quarter of 2023, SCB's return on equity outperforms 32% of its share price comparing to the market. Now, to the Porter's Force. The Porter's Force, the banking business is a lucrative business to be in, judges from its low threat to entry because 4 million cedis minimum capital requirement. Moreover, the moderate and makes the environment a fair ability to outperform the market. Coupled ability makes moving on to the investment thesis.
Yesterday is a history. Today is a mystery, but tomorrow is a financial gain with Standard Chartered Bank. Among the top 4 profitable banks for 2023, SCB demonstrated a third quarter return of equity of 32% against the industry's average of 21%. To our investment thesis, SCB showed a historical net interest income to operating income of 69%. Having recorded 60% in 2021, the bank showed growth to a strong 69% in 2023, affirming the bank's ability to generate interest from its core business model. Moving on to our cost mitigant, SCB meticulously mitigates costs, having cost to income ratio of 35%, historical average. Moreover, it shows the company's ability to prove efficiency in its expenditure. Looking at the economic environment, SCB stands strong when it comes to economic turbulence, a clear case from the impact of the domestic debt exchange program. Having been impacted largely by high impairment, the bank shows resilience and growth to a whopping 43% net profit for the third quarter of 2023. Applying the Camel analysis, it is evident that SCB stands strong with a prudent liquidity management, showing that it has a cash ratio above 30% for the last 6 years. Moreover, the non-performing loan of the company, standing at 8% in 2017, has shown a consistent drop to 2% in 2023 third quarter, proving the bank's ability to mitigate credit risk. Having a capital adequacy ratio above the country's threshold of 14% proves the bank's ability to withstand shocks when they arrive. Now, with a strong financial performance, the adroit risk management, indeed, SCB has a positive growth trajectory. Let's move on to our valuation.
Now, moving on to the true worth of our target company, SCB. To incorporate the effect of direct financing, more of the equity side valuation multiples and models were used to ascertain our target price. So for the relative valuation, all the banks listed on the Ghana Stock Exchange were used as the peers, and this is because these banks are the easy substitute for our target company, SCB, and they also have easily accessible and publicly available information. So using an industry average of the PE, PB, and then P to deposit, and that of the P to tangible book value, and applying equal weights, we arrived at an implied share price of 27 cedis, 55 pesos, which shows a potential upside of about 57%. Our valuation assumptions our valuation assumptions used were a risk-free rate of 23.5%, which was ascertained by considering the current policy rates, the yield on the 91-day bill, and the recent issuances of unsecured debt of Ghana. So incorporating all these assumptions, we arrived at a cost of equity of 26.80%, which becomes the discount rate underlining all our valuations. So looking at our dividend discount model, SCB has a history of paying more of its profits as dividend to shareholders. So we discounted our projected future dividend for the next 5 years alongside the terminal value to an implied equity value of about 2.9 billion Ghana cedis, which resulted in an implied share price of 21 cedis, 53 pesos, showing a potential upside of 22.65%. And then also, applying the same discount rate to our valuation, we arrived at a residual implied value of 1.18 billion Ghana cedis, showing a potential downside of 50% at a price of 8.72 pesos. And the downside in the DDM is actually as a result of the company's brilliant idea of paying more of its profits as dividend to shareholders. And then lastly, so applying adding a weight of 50%, 20%, and 30% to our DDM, RIM, and the relative valuation, we arrived at a target price of 20.77 pesos, which shows a potential upside of about 18% from the last trading price of 17 cedis, 55 pesos. And the good news here is that the shares of this company is actually trading at a price of 19 cedis, 25 pesos, meaning that the true worth of the company is actually being realized on the market. Now let's look at our investment risk and mitigants.
Every investment carries risk. But however, Gordon in 2009 affirmed that there's a positive relation between risk management and firm performance. SCB Ghana incorporates two types of risk, the systematic risk and non-systematic risk. The systematic risk arises from the external factors such as the interest rate, the exchange rate, and the inflation rate. However, because we've already identified that the industry has made us aware that the markets of the Ghanaian economy has really stabilized, and therefore this risk has been mitigated. Looking at the unsystematic risks, which are the risks that SCB can mitigate and control, they include the credit risk and liquidity risk. SCB Ghana has ensured their credit risk and liquidity risk has been mitigated. Looking at the credit risk, they have diversified their portfolios of loans and advances between various sectors of the economy, and their investment too has also been diversified starting from the year 2022 due to the DDEP between the local market and the foreign market. Their liquidity risk has been well mitigated. Looking at the industry, SCB stands out in terms of liquidity, having a cash ratio always above the industry for the past years. And also the ESG. SCB Ghana has contributed much to the society through their net zero, which concerns with the emission of a carbon, and also the stand of participation levels, which concerns with the social, and also with their government structure. SCB Ghana is very good, so that they have a structured governance and with committees which helps to meet strategic goals, and also they ensure that participation of women in leadership and management is high. Therefore, they have a policy that 30% of their management and leadership should be made up of females. Thank you very much. These are the reasons why I'm telling you that if it is because of risk that you are afraid to invest in SCB, then be rest assured that SCB will mitigate against it.
As my colleague has said, tomorrow is a financial gain. That tomorrow is now, as can be seen from the increase in share price of SCB. Thank you.
Okay, so maybe a general comment. Well done. Your presentation was easy to follow. I like the flow. The only thing I didn't like was the position for ESG. Because it drives into the forecast, you could have positioned it earlier. Great presentation.
Thank you very much. Obviously, you guys are quite bullish on SCB, which is great. Like Stacy said, the presentation flew quite well for all of us to follow. Again, I think I've said it in the other presentation, when it comes to ESG, you need to focus on where the ESG drives value or reduce risk. So you did make mention of the governance structure. You could have spent a bit more time in terms of how that reflects in the value. Other than that, like we always say, price is a fact. Valuation is subjective, so we will not banter over your valuation, but at least you've been quite consistent. You are bullish over it. The upside seems decent enough to convince people to buy. And a great job. Thanks.
Yeah, thank you. Great presentation. Team Macro Board. Yeah. Can you take us through your valuation methods and the reasons for the weights that you assigned?
So we used discounted dividend model, the residual income model, and relative valuation. For DDM, there are literature about how dividend payments affect share performance.
So, what the weights are, and then the reasons for assigning those weights.
All right. So for DDM, we added a weight of 50%. For RIM, this is residual income model is 20%, and then relative valuation was 30%. So we added a weight of 50% because the DDM being from the basis of dividend payment affecting share price, and then SCB being a typical financial institution, we all understand that dividend payments really affect share performance, so there should be a higher weight attached to it. The residual income model, which only talks about the money left or the income left to the business after meeting all these costs of financing, shows that, and because SCB has a history of paying more of its profit as dividends, it means that if we apply more weight over there, it's going to make the valuation more biased, in the sense that it will not reflect the true worth of the company. And then for relative valuation, we added a weight of 30% because we wanted to know how within the industry the value of SCB as compared to the industry, and you could see clearly that SCB is relatively at a discount rate as compared to that of the industry.
Don't you think that SCB's ability to pay dividends over the last couple of years and possibly into the future should have made you discount the weights that you gave to the DDM model?
SCB has made dividend payments in quite 2 years, and these are from systemic risks that were beyond the control of the company. So you could see that clear from that stance, during those periods they were unable to pay dividend. But then during the periods where the company is doing well, that is where you could see that the worth of the company is actually going up. And you could see that dividend payment is actually a big factor in the performance of the company. So if you really want to know what is actually driving the performance of the company, we are supposed to use the drivers or the metrics that really drive the company. That's why we added that way to it, because DDM is one of the big drivers of the performance of SCB.
Thank you.
So probably a related question. Your relative valuation model, you used the industry average and considered every bank that is listed. You can go there. So two issues about that. SCB is considered a large cap stock. And so typically you would want to segregate and compare apples to
Investor, when you want to buy a stock, a financial stock, or let's say SCB, the other stock that you consider, which is the opportunity cost, are the other banks in the system. So that's why I explained in my presentation that we use these banks that are listed on the exchange because, one, they are the easy substitute. So if an investor wants a banking stock in its portfolio and the investor is not buying SCB share price or SCB shares, which other bank can SCB buy? Can the investor buy? And that is the SCB bank.
Yeah, I get that, but I thought maybe an EcoBank and a GCB would be closer, looking at the size. What about the premium?
So a company can be trading at a premium, which doesn't necessarily mean that the company is not doing well. So the premium means that investors value their company share a lot, so they are willing to pay more for it. And this is actually reflecting the performance of the company, because on Wednesday the share price actually increased to the current price of the 19 cedis, 25 pesos.
So what I mean is, when you look at your median, is 0.51 for price to book. Your mean is 0.81. SCB is 1.45. So you see that SCB is trading as a premium to all the others. I mean, let's take out ADB, all the other peers. Okay, and that has been consistent in the past. Okay, largely because of the high ROE that SCB has had in the past. So my question is, did you adjust to account for the premium that SCB commands? So that's something to look out. Maybe you can run us through some of your assumptions for the forecast.
So we have a risk-free rate of 23.50%.
No, not the cost of capital. The forecast.
Okay.
Yeah.
These are the appendix there. So with the interest income, realize that the year-on-year growth was from 6.76% in 2017, and then as of the third quarter, it was 37.85%. And then checking the interest income rates, so interest rates, so it's like the interest that the company is making from the asset that generates the interest. So it was 13%, and then it went to 7.5%, and then we used an average of the 5 years, which was the 11.15%, which was because we want to be quite conservative in our forecast. So the interest expense, we used the same reasoning to get the interest expense rates, which was 2.64%. Then the assumption using becomes the same for the forecast period. And then we had the credit spread commission to.
What's the fee and commission income rate?
That one was 2.57%.
Define it.
Okay, so the fees and commission income rate, it's a ratio of the fees and commission income to the asset that generates the fees and commission income.
What are some of these assets?
So So fees and commission income is from the services that they provide on the customer deposits, and then the brokerage service that they provide to buying shares or securities for clients. So for balance sheet too, for assets under the cash and cash equivalents, we check the year-on-year growth rates, the cash ratio as well. So this cash ratio is actually the cash and cash equivalent as a percentage of the total assets. That's what we're looking at. So for liabilities too, the customer deposits. So have year-on-year growth rate.
It's fine. I've seen what I wanted to see. All right. Your beta calculation, how did you do it again?
So it was accounting beta, which is the standard deviation of the earnings per share of SCB for the past 10 years. Like accounting way of looking for beta.
So I'm familiar with covariance of the stock and the market return over the variance. Yeah, so that's what I'm familiar with. But so you just
What are investors expecting at the end of the year on the performance? So we check the performance of the GSE Composite Index last year, and then based on that we use, yes.
So typically, because you are doing, equities are held into perpetuity. So mostly you would want to consider maybe a few years back, yeah. But that's fine. Maybe moving into your assumptions a little bit. What are your expectations of interest rates, and how do you expect it to feed into the performance of SCB?
Okay. So for
there is a mark for teamwork, okay? So don't let me pass.
So for the interest rates, right now the policy rate is high, 29%. As at the time we're doing the evaluation was around 30%. So it's from the onset it discourages people from going for loans. But this company also has a strategy of buying government securities, which is actually now at a higher yield, and that will result in them being able to generate more interest income, and that will feed into their bottom line, which is their net profits, and then eventually affect shareholder wealth.
Okay, I didn't see any scenario analysis. Did you do any scenario analysis, like sensitivity analysis?
We did sensitivity analysis.
Did you show it in your
Yes.
presentation?
No, it's in the appendix.
So maybe you can show it and walk us through quickly.
So for the residuals, with a long-term growth rate, a lowest around 0.69%, and then the highest around 4.69%. And then that of the cost of equity, so the lowest around 16.80% and the highest around 36.80%. We see that the share price can range between 25 cedis, 89 pesos, to 30 cedis, 44 pesos. And there can even be a downside where the price can be trading at 45 pesos and then that of 47 pesos.
Yeah, your residual income value of 8.73 is very interesting compared to the market price, current market price. Yet, in the middle of all that, is that not the reason why you give it a lower rate though? Coming back to his question, but I mean, notwithstanding that, in the overall, you are issuing a strong buy recommendation. So can you speak to that a little bit?
So SCB having a history of paying more in dividend when they make profits, realize that the residuals or the income that they will keep in the books or the income that will be left to them is not relatively big. So if you consider only that in your valuation, you'll be biased. Like your result will not reflect the true worth of the company. So that's why we give it a lower weight, not even necessarily because of downside. In fact, the 8.72 actually tells us that in the books alone, the company has this, apart from what the company is paying out as dividends to shareholders.
So more to that, we realize that since the payout ratio is very strong, they will be paying more dividend. Because of that, the residual income will be relatively short. So if the DDM is strong, then inversely, the residual income model will be smaller.
You see why other people should be helping him answer that question. Okay, my final question. So you said that SCB has a high capital adequacy ratio and a high cash ratio, right? Do you think that they are sweating the capital enough to generate the returns that shareholders deserve?
Can you please rephrase the question?
The sweating. So what I mean is that the utilization of the capital to generate, because you see, you have capital, based off the capital, you can give so much loan, you can have so much single obligor, etc., etc. So my question is, based on that, they have such a high liquidity ratio. Do you think they are making very good utilization of their capital to generate a lot of return to shareholders?
One of the key things that you would take from is the prudent liquidity management. So they can't, at the end, put more of their money into only loans and advances. They would have to restructure and keep some in the short-term cash equivalents. So
I understand. So let me just interject before you come in. I understand, but you see, the industry is at a certain level. There is a regulatory requirement on that. Yet they have gone so far and beyond, even above the industry. So that's what I'm asking.
So SCB being a traditional bank, meaning they take deposit and make loans. So what we would consider over here is that with the advent of fintech, where mobile money companies who don't have a deposit taking license, they end up giving the money to the banks. See, so whilst the customer deposit is growing, meaning they have a lot of money, to make more money to add up to their books.
So you are telling me they are not sweating it?
No, please.
Okay, thank you.
Sorry. So a word on ESG. A second. Okay. All right. So just a word on ESG. I noticed that there's a lot of focus on what the company is doing in terms of their corporate social responsibility, governance, etc. And this runs through most of the teams we've had so far. There's little focus on where the company does business work, because in my experience, it affects how much they spend on expenses, operational expenses. So you take the Stanchart building, for instance. It's relatively new. Is it a green building? How has it impacted on their cost of operations? Because there's ample evidence to show that green buildings generate, you need fairly low amount of electricity consumption, etc. It affects how much you spend on the building. So when you're looking at ESG factors, don't just look at what the company says they are doing, but what in practice, what are they practicing? How is it affecting on their operation? Impacting on their operations as well. Yeah.
Thank you. We have shares, but not SCB. From here, we are going to buy more shares.
Actually, from getting the money, winning the money will be there.
So as I know, nobody who holds a share in any company, in any listed company. You have shares, which, okay, you don't need to disclose. That's fine. If the 5 of you were appointed as the executive committee of Stanchart, what's the one thing that you do? Just the 5 of you, they walk you to the head office. You are ESCO members. What's the one thing you do, assuming we were the shareholders, to drive value? Based on all the things you said, what's the one thing? Just one, no longer say.
me, I'll invest more in technology. Because technology drives, it improves efficiency, and that and then also improves your profitability. So even though the company is doing well, it is not a point to relax. It's time to do more.
I just wanted to end with a general comment. I think your presentation was great. I didn't enjoy your question and answer session as much. So that's something you should work on. Okay, try and anticipate what questions are likely to come and get ready for them.
Okay, very nice presentation. You can have your seats. You can be seated, right? Okay, so the next thing will come, or unless you want to go and pick something. Now, okay. So wait for the last team, and then after that you go for them. For some of us, anytime we go for events, there's a special item. It's very important. Okay, so let's clap. Let's give a hand of applause.
Good afternoon. We are Team Valor. Standard Chartered Bank Ghana, popularly known as StanChart, is a leading multinational commercial bank in Ghana. StanChart provides services to three main client segments: its corporate, commercial, and institutional banking business, its consumer, private, and business banking business, and its wealth management business. We see that StanChart's core competitive advantage lies in its corporate, commercial, and institutional banking segments, accounting for 68% of financial year 2022's operating income. In terms of its positioning in the market, StanChart ranks 8th out of the 23 banks in its share of industry loans and advances, and 10th out of its share of industry deposits. So StanChart is largely foreign owned, and the free float is just about 30%. StanChart's key revenue sources are from its net interest income, its net fee and commission income, and its net trading income. We'll now learn how StanChart is impacting Ghana.
Investors today look way beyond financial returns. They prioritize companies that are committed to ESG, and SCB Ghana is of no exception. Environmentally, they are committed to a net zero carbon emissions by 2050, and they partnered with the Wildlife Division of the Forestry Commission to plant about 1,100 trees in 2022. Socially, they are making so much impact. SCB Ghana has seen an enhancement in its employee well-being by a remarkable 73% work-life balance satisfaction rate. As if that's not enough, SCB Ghana, through its Seeing is Believing initiative, has impacted about 5 million Ghanaians all over the country. Again, through its Women in Tech Incubator initiative, they have helped 30 female SMEs scale up their businesses. Strong governance underpins it all. Strong governance underpins it all. SCB Ghana has a fair pay charter principle which ensures equitable pay to all their investors, to all their employees and their executives, as well as a female board representation of 33%. And with Masaneta as their current CEO, we are really assured of their active involvement in gender diversity throughout the organization.
So our fundamental analysis of Standard Chartered Bank led us to a 19.9% downside, representing a 14 cedi 4 pesos target price. Now we've narrowed down our analysis to three overarching themes that embody this sell recommendation. First of all, we found that the market has failed to adequately price in the incoming rate cuts that will squeeze net interest margin and have an impact on the bank's bottom line. Moving forward, we expect dividend payouts to slow owing to exchange rate dynamics, and the fallout from the domestic debt exchange program. And finally, with the Ghana reference rate north of 30%, the cost of debt is extremely high, and we expect default risk to be higher than ever. So to set it off, the Monetary Policy Committee has, for the first time in 17 sittings, ticked down the monetary policy rate to 29%. We find that while the other macros come down, the bank's yield on assets is going to fall by an estimated 50 basis points, and competition will squeeze the bank's ability to take down yields on liabilities, and that will squeeze net interest margin going forward and have an impact on net interest income. Moving forward, the foreign ownership of Standard Chartered Bank we evoked earlier comes into play. We find that the Bank of Ghana will lay a heavy hand on approved dividend payouts in order to shield the already struggling cedi from further depreciation upon remittance to foreign shareholders. There's a further concern as the Bank of Ghana expects banks to focus on recapitalization following the erosion of capital from the debt exchange program. Now, moving on, the Ghana reference, important to note that the margin of overperformance is thinning out, and that is a very important assessment we make. Net interest income has been driven largely by the CCIB division, given that the bank is more corporate-oriented, and interest expense has been kept at a reasonably low margin away from interest income. However, we expect this to thin out going forward as the rate cuts are priced. Emmanuel will take it from here.
Standard Chartered Bank capital adequacy shows impressive strength and resilience, as shown by its capital adequacy ratio and common equity tier 1 ratios trending above the required minimum capital requirements. Unfortunately, the asset quality of Standard Chartered Bank is deteriorating, evidenced by the increasing non-performing loans. The current high cost of borrowing and high inflation environment in Ghana is adversely affecting the businesses in the sector Standard Chartered Bank lends to, ultimately affecting their inability to repay these loans. Subsequently, we forecast that this high rate environment will continue in the short to medium term, thereby impacting the profitability of the stocks of Standard Chartered Bank. In essence, you can see that the liquidity position of Standard Chartered Bank is very strong, given that it is trending above the industry average and its notable peers like EcoBank. The current cash reserve ratio of Ghana is at 15%, from a 12% increase in December 2022. While this hike in cash reserve ratio improves the liquidity position of Standard Chartered Bank, it comes at a profitability trade-off. Now, going into the future, with the cash reserve ratio being at 15%, the bank's deposit will shrink, thereby impacting the amount of funds they have to loan out to their customers. And this would impact the interest income they earn on their loans, thereby affecting their profitability, which accounts for their declining return on equity leadership that we had already shown. This financial analysis set the stage for our valuation, which Antonio would elaborate on.
Our target share price of 14 cedis, 14 pesos, is the weighted average of three main methods: the dividend discount model, the comparable price to book ratio, and the comparable price to earnings ratio. We weighted the DDM at 50%, and then the price to earnings at 25%, price to book at 25%, just to achieve a fair balance between our intrinsic and relative valuation methods. So the discount factor in the DDM is the cost of equity, which we obtained using a two-part capital asset pricing model. So we have our forecast years, which is our 5-year forecast. We found the risk-free rate using a 5-year historical average yield on the 91-day treasury bill. However, for our perpetuity growth period, we chose the yield on the 10-year government of Ghana bond pre-COVID-19. And this is because we expect Ghana to go back into the domestic debt market. Right, so this led us to the cost of equity of 35% in forecast 5-year period, and a perpetuity cost of equity of 26%, which is quite high. Next, so dividend discount model also assumes that there's a perpetuity growth rate of dividends. And now this terminal growth rate assumption was found from the interplay of nominal GDP, which we realize largely correlates with the performance of banks. And then we also employ the Gordon growth model, which is an intrinsic valuation method. And then we have the terminal growth rate of 8.7%. We further perform a sensitivity analysis around our terminal growth rate, our risk-free rate, and our terminal cost of equity. And all these share prices lead at one thing: the stock is overvalued. Finally, with our comparables, the peer set is the 7 other listed banks on the GSE. We see clearly that Standard Chartered is trading at a premium in both ratios, but the price to book value ratio is more significant. The combined effects of this is a target price of 13 cedis 18 pesos, emphasizing the sell recommendation.
Our sell recommendation is heavily driven by 3 major risks. We have the credit risk, we have the foreign exchange risk, and the interest rate risk. From our analysis, realized Standard Chartered has higher impairment losses on loans and advances made, with majority of these loans and losses from the sector impairment. Okay, this is due to the high cost of environment facing business within the sector, making it difficult for them to repay their loans. Also, we realize that this has fed so much into performing loans trend SCB. However, we expect that in the short term, if there is still increase in the interest rate, this is going to amplify the bank's credit risk. Also, we realize that Standard Chartered is amplifying and also contracting its loan ratios with a loan to deposit ratio dip. However, we expect that this is going to pick up gradually as the economy stabilizes. Standard Chartered is also faced with a foreign exchange rate with a substantial amount of foreign currency deposits and a foreign currency denominations loan own. We analyze that Standard Chartered is going to be risky, since that because of the prevailing depreciation trend of the country, of the depreciation trend of the Ghanaian cedi against the currency denominations, Standard Chartered is likely to post higher translation losses if there is impairment of these loan denominations of the bank. Also, it is likely to show higher liabilities on the profit balance sheet, looking at the cedi equivalent depreciation of the Ghanaian cedi against foreign currencies.
And so we classify interest rate risk as the most pertinent and most impactful risk on our radar for the very reasons I explained above. Standard Chartered Bank has reported a positive repricing gap in financial years 2020, 21, and 22, which just guarantees that should the rates go down, net interest margin will not be left affected. To sum it all up, our dividend discount model, our comparable price to book, our comparable price to earnings, and our sensitivities all point in just one direction. The macroeconomic situation dictates that this is no time to invest in Standard Chartered Bank equity. My name is Gerald Benson. From the left is Antonia, Pamela, Jonathan, and Emmanuel. Team Valor, thanks you for your attention.
I think you are very bold in taking a position, like recommending a sell on Standard Chartered, and I think the presentation, it was easy to follow.
All right. Yeah. Thank you for a very good presentation. When I saw the sell recommendation, I was expecting to hear along the line that these people would say, "Oh, treasury bills are going to be affected by DDEP, and so they are going to take more impairments, and so that's how." Yeah. So the fundamental reason underlying your sell recommendation has to do with the asset quality, and that you expect the macroeconomy to make it worse. If you look at Standard Chartered, and in fact most other banks, they are slowing down on loan growth. And so if they are slowing down on loan growth in a way to manage the overall macroeconomic picture, aren't you placing too much weight on the impact of the economic downturn and the deteriorating asset quality on your assumptions going forward?
So yeah, interesting question. So in our model, these are priced into until these flow through the macros of the market, we expect non-performing loans to remain alarming. So until those are priced in, the non-performing loans are expected to remain a worry. So in terms of what you said about the weights, in actual fact, this is not the main weight on our model. The main, I would say, is our interest rate risk, and that feeds directly into the dividend caused by the macroeconomic situation. Antonia apparently has something to add.
Yes, so just to add to what you said, I think you mentioned the fact that the banks are responding to this poor asset quality by contracting their loan book. We feel that we realize that that is not a very sustainable approach. The banks would the drive of their interest incomes and margins from the loans. So if asset quality is a very alarming factor that the banks are experiencing, it cannot be totally eliminated because their business model is driven off giving out loans.
Can we see the trend of their asset quality over the period?
So this is our non-performing loan trend. So we see there's a steep hike owing to the high inflation, high cost of debt, city depreciation environment that inherently impacts the sectors that Standard Chartered loans to. And then we see that even moving into Q1 2024, we see that this is still quite high. And this is going to affect bottom line profitabilities because when they charge off these loan write-offs, they are written off in the P&L.
So I'm assuming that Q4 and Q1 are projections. Q1 2024 and Q4, those are projections.
Yes, sir.
Okay. Yeah.
Yes, sir.
Okay, all right. So essentially, you are projecting that the NPLs will go higher. You're not.
Yeah. So even though we forecasted a tick, which is in line with rate cuts, we still think it's going to loom at an upper bound in the short term.
Okay, all right. Awesome.
I think you touched a bit on the question I was going to ask about rate cuts. So I was going to ask about your expectations of interest rates and how you expect that to feed into NPL.
Yes. So we attribute a soaring non-performing loan trend to the high cost of debt environment, high inflation, high cost environment. And if we are experiencing rate cuts, the Ghana reference rate, for example, is driven off inflation, is driven off the monetary policy rate and so on. So this is going to, so the sectors that the bank lends to is going to pick up on this. Perhaps their cost environment will not be so high, which will impact their ability to turn around those loans. So if rate cuts penetrate through the market, then we do anticipate the non-performing loan ratio to improve. However, in the short term, we think these rate cuts will not be too steep, and so asset quality will still be a very looming impact on our one-year target price.
Forecasted for these lines.
Which lines exactly?
I'm sure you have forecast. You have a forecast page. So can you move to your forecast and then?
Are you referring to a financial statement forecast?
Yes.
Okay. So we have our income statement, and I'll let Gerard do this.
The assumptions is further down. Yeah. Go back on page. Okay, that was further down on the page. Okay, so in terms of rate cuts, we're going to jump around a little bit here. If you go back to back again, to the first one. Yeah, yes, with the MPR, for example, if we're talking about our forecast around the effect of the changing rates on the financials, if we start from here, as the rates is going up, we've implemented that first 100 basis point decline in the policy rates at the end there, and we'll go to the effect. If you can go back to the very first theme, the first theme at the top of the slide. Okay, so it's having problem transitioning. That's all the way at the top. Yeah, okay. So what we priced in, we went back to what we considered the years we are approaching. That's back in 2015, 2014, where the rates were at where we believe they are approaching right now. The Bank of Ghana estimates an upper bound of 13% and lower bound of 6% for inflation by the end of this year. Back when rates were at that point, we went to find what Ghana reference rate was, what monetary policy rate was, and also studied how Standard Chartered Bank's financials responded to those. And then we regressed the rates towards those rates gradually and expect that by the end of this year, those rate cuts would have priced in. So up until those rate cuts come in, we still have, we're still pricing in those high non-performing loans while gradually declining our asset yields in line with that.
So why is it that for the next 5 years, your cost of equity?
I think I'm good. Thank you.
Hi, thanks. Just a quick feedback. From experience, Standard Chartered Bank and another bank are pretty conservative when valuing their assets, and almost they are the bellwether for the industry when it comes to NPL. A lot of the local banks take a bit of time before the NPLs begin to filter through P&L. So they may have a high NPL. It does not necessarily reflect their actual credit risk management. It probably, I mean, SCB on the group level are quite aggressive when it comes to recognizing defaults, even when they have not crystallized, compared to most of the banks. So they typically, from an industry perspective, have high NPLs when the macro environment is a bit sticky. So that may explain why they have the high NPLs compared to other locals, because the other locals, we are in a local space, so let me be careful. Other banks take a bit of time before they recognize, so just have that in mind.
Yeah, thank you for the insights.
Okay. The other bit, my other question also is that, look, you are investing for the future, which is almost like a guesswork, or you are betting. Things can change quickly. Whilst I appreciate your bold stance in saying let's sell SCB, you should also factor in the trigger point that could make you pivot from your decision. So for instance, you could have added that, okay, we say sell, but if tomorrow, for some reason, Ghana get 20 billion or 5 billion, 10 billion, free money from AJ, the conversation changes quickly. So we will not, you get, so you kind of cover yourself. So once you decide to go on that okay, let's sell or buy, always have what could make you pivot your stance. Okay. And then your cost of equity of 35, right? Is it 35?
So we have, yes, so we have the forecast. So our 5-year period, given the high interest rate environment, which we expect to fall, but not so steeply, we find this cost of equity at 35.29%.
And what's SCB's ROE?
Right. So let's go to the ROE. Yes. No. Exactly. So we see it hovering from about 20%. Sorry. Yes, so basically that's the trend. It's 2018 it starts around 20%, hikes to about 32, and then gradually dips, and then we forecast it to improve.
Okay, so 35 is quite high over the next 5 years, which presupposes that you guys are quite bearish on the macro environment.
Yes.
What's your 5-year forecast of the dollar in 5 years versus the CD? Because that will give me a certain sense of where you're coming from.
Sure. So currently the dollar is around 12 CD 50 pesos.
30.
Sorry. 30. Yes. So I think a lot of the assumptions around what the forecast would be determined after perhaps this election year and then the outcomes of our IMF negotiation. So given the uncertainties currently, it may be very difficult to project too long for the FX rate. That's what I would say. But in the short term, perhaps a 3-year forecast, I project the dollar to move to 15 thereabout.
That's very bullish. That makes it inconsistent with your 35% cost of equity. You guys, I mean, your 35. Again, we can disagree on the 35, but just the building blocks of the 35, I'm not too sure it's too clear. I think you've projected quite a bit of the current bearish stance into the future, which is fair. But you may have to. So what happens if your 35 drops by 5% or
Yeah,
10%?
so we perform that sensitivity around the risk-free rate and the cost of equity. I don't know if we can go to that page.
Yeah, okay.
Yes, so we felt the biggest driver of the cost of equity was the risk-free rate. And that is currently under serious contention given the current macro space. And so this risk-free rate sensitivity gives us a range of step prices. We used a 1% step flex. And so we see that even as we flex it downwards, we still have.
Okay. So your risk-free rate will be in the teens. And what's the risk premium?
Yes, so the risk premium had 19%.
19%?
Yes. Wow. So with the risk premium, we assume, so the premise of the risk premium is that we assume an investor has a global portfolio. And so our risk, can we go back to that page? So our risk premium is determined by also considering Ghana's country risk premium, which is very high at the moment. So it's actually a sum of the US's equity risk premium and Ghana's country risk premium. We think that is, in the context of this stock pitch, this is a very, very good risk premium to include.
I think that your application of Damodaran's country risk premium in determining the cost of equity is part of the reason why you have a high cost of equity.
Yes.
We all think it's too high.
Okay.
So that's something that you may have to look
Sure.
into.
Yes, I think, yes, exactly. So that
The
is Damodaran's.
Damodaran has some literature around it. You may have to study it.
Yes, so the reason I use it was because it's an international competition. And then
It's fine to use Damodaran. I just think the application of it was done in such a way that it's throwing this number.
very high.
I'm saying that because I have used it
Okay.
to estimate the cost of equity, so I know what I'm saying.
Okay, sure. Thank you so much.
I'm not sure it's too high, but I don't know.
I think it's high for the next 5 years. Okay, so it's a debate.
Okay, all right. Just again, how many of you have washers? Nobody. Okay, you guys are selling, so that's okay. All right. Thank you.
One last question before you go. So I think you indicated that, let me get it right. Okay, SCB has high liquidity, okay? As interest rates go down, don't you think it's easy for them to deploy it into earning assets and probably generate a lot of returns, which would actually feed into the share price?
That has been priced in. So if you look between the end of 2022 and Q3 2022, the end of 2022 and the beginning and Q3 of 2023, the bank's deposits rose by 34% in just 3 quarters, right? So that does signal high liquidity coming in, and that largely drove our assumptions going forward. And all those were earning assets, and our assumptions, we did price in those rate cuts alongside those new earning assets that have come inside, you know. Yeah, that's further down, way down, in the appendix.
Just to add to that, we also consider the impact of the regulator on the cash reserve ratio, given the DDEP and the financial sector cleanup. We think the regulator is going to keep a heavy hand on these cash reserve ratios, which will also impact the liquidity trend moving into the future. But we do see Standard Chartered Bank taking a very, very conservative position. Yes, this may be, so we still see it taking a very conservative position with this liquidity, and that is affecting its declining ROE leadership. We see the trend initially is doing significantly, outpacing peers significantly. But now, and even in our forecast, we forecast this to reduce. So thank you too.
Thank you. It's been a very interesting competition. And I don't know if, to the audience, if you are a fund manager, will you buy or or you use your money for antimony? Okay, so we've reached one of the most critical sections of this competition. Very critical and very important. It's needed for survival to continue. So at this point in time, you go for lunch, but we'll move in this order. So first, I'm waiting for my algorithm to, yes, it's in. So we have the judges. The judges will first move to the left. Then we are having the lunch on the ground floor. We are having a lunch on the ground floor. So ground O. So the judges will leave. Then the faculty. They're followed by the faculty, mentors, and graders. So the judges, then after that, the faculty, mentors, and graders. And after that, the student teams. I mean, the contestants. And then after that, the last will be the audience, including myself. So. Okay. Okay. So I think it's time. Faculty.
to see your value. I rose from being an associate. Now I am the principal of investment at my current firm. My name is Isaac Asmani. I'm the investment principal at Wangara Green Ventures. I have a solid background in finance. I started off by doing a degree in banking and finance at the university. Right after degree, I went on to work with an investment banking firm. So we did things in private equity, a bit of venture capital, and then brokerage, and then mutual funds as well. Throughout this journey, I had a passion for finance. I had a passion to excel in this field, but I thought that I needed to have a global certification to be able to break boundaries and to be able to help me further my understanding of finance. And that led me to want to pursue the CFA program. The CFA program is the gold standard in certifications when it comes to finance. At the time, I had read about how the CFA programs equips you with the needed financial skills. So it was a no-brainer. I needed to get to the CFA and to excel and push my career to the next step. The CFA program is a challenging program, but I failed the level 1. I didn't relent. I learned about patience. You need to put in the work, countless number of hours, and then having the dedication to continue through with it. It also taught me about humility. I mean, the vastness of finance. Even though I had the experience, I realized that there was more to finance, and the CFA really equipped me in that aspect as well. In the ecosystem in Ghana, we face a demand and supply problem. So the demand for capital by these entrepreneurs is so high, whereas the supply of the capital is low. And so from the onset, you need to do rigorous investment. The CFA program prepared me for that. How do I allocate scarce financial resources to the right entrepreneurs and to the right areas where we can have the proper impact? And then helping these companies to grow. And when they grow, they contribute to the climate change mitigation, they contribute to climate change adaptation as well, and then they contribute to social impact, which is job creation, improving the income and the livelihood of poor people, and these sort of tie into the sustainable development goals. So the transition from asset management into impact investing and venture capital was a pivotal one for me. In asset management, I did a lot of investment analysis, the whole idea.
But thanks for the offer. At Cal Bank, we offer both, it's a universally licensed bank. So we from a consumer and retail banking to corporate, to commercial banking, to the high net worth. And then we have the investment offerings as well. So irrespective of who you are, where you are, we cater for you. Under the individuals and the retail or the personal banking, we have students, we have children, we have individuals, adults. I account for all these categories of people. We even have for retirees or for individuals planning their retirement. And then under the corporate, we also have for corporate, for institutions, we also have product offerings for the businesses and the SMEs. We also, under our treasury investment product, we have Cal Asset, that is a subsidiary on its own. We also have, we sell for government. We also do customized Cal Bank fixed deposit, Cal Bank investment, Invest Plus products. We also have our digital. We are big on digital. So we try to support as much of our transactions, as much of our banking as possible with our digital channels. So we have the app that I will encourage everyone to download, to use, because using the app, you can basically do everything from your normal savings to the investment to even applying for, you can apply for a facility, but you can even start the process. And then when it comes to asset management that you're already aware of, I don't need to go in. So I think I've covered everything, if I'm not sure. But thanks for the opportunity. So I'll encourage everybody to download the Cal Bank app. Sign up. You can just use your card or your Momo. You link it to their app and then start transacting. You can open a Snap account. We also we have, because of financial inclusion, we are at every corner, every neighborhood through our agent banking service. So you can walk into any agent, perform all your banking solution if you don't want to go into any Cal Bank branch. But outside of that, we are across the country. So anywhere we are, anywhere you are, you can reach out to us. Thank you very much.
Thank you very much, Vicentia. So we had to give her the opportunity to speak first because she's our host. She graciously accepted to have us all come into this building, and we are very grateful for that. My name is Ernest Atiso. I work with Cal Asset Management Limited. I think that during the interactions, you may have noticed Isaac asking almost every team whether they have investments in shares. He's trying to averse your minds to something. You know, it's very important to develop the culture of investments as young people. People like Nana Riafe, when we're back in school, they instilled the culture of investments in us by setting up investment clubs that we could join. The beauty of joining investment clubs, okay, is that you don't need to have money to be able to buy Stanchart shares, but together you can buy Stanchart shares, you can buy Cal shares, you can buy, today you can buy Google shares, you can buy NVIDIA shares, because there's a wisdom in pooling your investments. And vehicles have been made available for people with 10 cedis all the way to 10 billion cedis to be able to invest through such vehicles. One such vehicle is the Cal Benefit Unit Trust that we sell here at Cal Asset Management. The Cal Benefit Unit Trust is a fixed income fund, and it offers the advantage of liquidity, it offers the advantage of safety. And what it says also is that we, at the inception of the Cow Benefits Unit Trust, did not limit ourselves to investing only in Ghana. So for those of you who are afraid of sovereign risk, if you had the presentation from Team Valor, they are very bearish on Ghana, okay? But the Cow Benefit Unit Trust, I mean, gives you the benefit of investing in a fixed income product that is diversified all over the world. Then there's the Cal Advantage Unit Trust. We like to position the Cal Advantage Unit Trust as an investment vehicle that would take you towards a safe and comfortable retirement. It's a balanced unit trust. So we have investments in shares like Standard Chartered. We have investments in fixed income instruments. We have investments in commodities. And then also we have investments in cash. These investments are fairly new in our industry, but they are growing quite aggressively. And we can promise you that if you have any concerns about your money coming back when you invest your money, because you've heard people telling stories about their monies being locked up elsewhere, I can assure you that Cal Advantage and Cal Benefit Unit Trust, we'd like to believe that they are the most liquid investment products in the country because of the underlying instruments. None of them is affected by DDEP or whatever your concerns may be when it comes to investments. So we're just a minimum of 100 Ghana cedis. You can sign up to invest in our products. You can see some gentlemen and ladies in T-shirts around after the program. If you are interested in signing up for any of the products, you can speak with them. They'll take your contacts and then they'll take you through the process. Thank you very much for coming into our space and for giving us a very good treat in the form of the presentations that we witnessed today. I wish I had this wealth of knowledge when I was in your situation, or when I was a final year student in school. I mean, I would have been in a much better position than I am now. So congratulations to all the contestants and their teachers. And thank you very much, CFA Society, as well, for the partnership that we've had with you over the years. And thank you all, and have a great weekend when you leave here.
Thank you very much. At this point, we move on to the next stage, which will be the presentation of the souvenirs and the... Okay, so we will be at this stage, we'll be presenting the certificates and souvenirs. So I'll call on my president and stand next to me so that we do.
If you'd ask me again whether I would want to do the CFA program again if that was allowed, I would say yes. Why? Because of the value it has brought to me, the impact it has had on my career, and that comes through because of the top quality of the CFA program. My name is Isaac Okumensa, and I am a manager at the Syndications and Capital Markets Department of Consolidated Bank, Ghana Limited. Initially, I started with the retail department of the bank, and then I wanted to really move to the credit department. But I got to see that to be able to function well as a credit person or a credit analyst, I needed to strengthen my financial background, given that I didn't have any financial background with my first degree, biochemistry. So having that in mind, I decided to pursue the CFA.
Also from Ashesi University. To be Regina Akafo. Great. Also from Ashesi University. Then we have John Terry Nana Ajay. Ashesi. So we have Kala Asiedua Frimpong, also from Ashesi. Let's them. It's a very bold decision, you know. A very bold decision to subject yourself to scrutiny from pension fund managers, industry experts. Move on to the next badge, which is a contestant from Kwame University of Science and Technology. We have Boy Lois. So after her, we have Asamoah also Prince. And the next one is Etuahene Comfort. Then we have Prosper Butungu. Okay, so we go to, and that's so Chelsea Team B. We Salina Odro. Followed by Edu Isaac Cole. Let's clap. Okay, so I think Edu Isaac Cole from Kenyan UST. Why did you apply? Oh, yeah. So we have Adipa Elom. Okay, so and we have Fobuzu Imbishi Clara. Don't worry. You see, proud to you coming here. I told them I have phonetic issues. Come and see me here. We have Clara. Clap for her. So we have a citizen from Ashesi. Akapo Benjamin. Okay, so we move on to the next batch from UPSA. We have Noah Majorin. To be followed by Ofosu Kevin. And followed by Ofori Benedicta. So we have Ehian Kumsi Manuela. Then we have Ajiman Francis Oscar. Okay, so at this point in time, I consulted a free to consult the AI that have been computing everything for us. So at this point in time, we would like to. University of Ghana, you have your certificates, right? You don't have. Yeah, yeah. So I thought it was a badge. Don't worry, don't worry. See, uh, so the AI is actually it starts with the fifth place. The fifth place, and Nana, I would like you to come here so that you give them a handshake. Um, so based on a very competitive. In fact, AI had to break down like 3 times because the computations and analysis it was doing was very complex. It was in either eighth dimension or something. So it has to be, it couldn't work on ECG. It couldn't work on ECG because a high complex computation. So at the fifth place, we have the AI gave us Team Cap X. Clap for them very well. Clap for them. I mean, they so well. Team Cap X, are you here? Can you stand up for a handshake? In fact, it's a very, very, very bold decision. It's a bold decision. You've done so well. So well. You've done so well. In fact, the AI and the algorithm had to break down because of the computation between the fourth and the fifth. It was so tight. Yeah. Okay, so do you have a word, the team leader, do you have a word? Yeah. It's okay, right? Yo, clap. You see, there's one thing about a photographer. I'm also part of the, but anytime I get closer, you go. As if I come in, it's an error. I was part of the whole. Okay. Let's give them a hand of applause. So the results for the first place. Okay. For CFA. Yeah, the fourth place goes to Macroboard Advisory. Macroboard Advisory. So okay, so whilst we fix the no, I'm okay. I want to check behind the PR and the You see, the photographer was not putting me in the picture, so I just wanted to create some demand. You know, it's all about supply and demand. You know, so I just created demand right now. See the place, the way the place is. I'm now the star boy. So we move on to the third place. The third place to Team Kvet. Right? Team Kvet, if you're here. Okay, so the first runner-up goes to Team Valorem. So I think there's guys. You have to. You need this. It's, the money. I should stand somewhere. You see, so you see the essence of supply and demand. Now I can. Okay. And the winner for the 2023. Have I jumped someone? Oh, you are expecting. Okay, so the winner for the 2023-2024 CFA Institute Research Challenge is Capital Creators. Okay, so at this point, I think there's going to be other sessions. As your local host coordinator, I'm ready to answer all your questions. So there will be a final from our president, and there will be a group photo session, and there will be some photo shoots if you want to take photos. And don't worry, just don't take it hard on yourself, right? It's just a competition. That's how life is, you know. The scores. Okay, so don't worry. When I'm done, I'll be here for you. I'll be here like 30 minutes, 40 minutes. to answer your grievance. So I'm here for you. So at this point in time, we call on our president to come and give us the closing remarks, and after that, we will have a photo shoot section, and then I'll be available to answer every question. Thank you.
All right, so thank you, very much. And indeed, we are proud of all of you. So what we'll do this time around is we'll share, the written report, right, with you. I know, few of the graders who had very, useful, feedback and comment. And we believe, those feedback would be for your benefit, for the purposes of your career, going forward. So we'll share those comments with you. The written report, obviously 50%, and then the presentation 50%. So once you get the report, you would probably, understand, why you placed, where, you placed. But then having said that, we are indeed, proud of you. Before, the competition started, my friend, Agbuama, asked me a question. How are we going to absorb, this teaming, talented, guys in our market? Our industry is not growing, right? We've all been impacted, by DDEP. What I tell people is finance, like it or not, is a North American game, right? All the stuff, you read in your book were written by North American professors, right? When they propounded, the risk-free rate and the risk-free thing, it was, U.S. government, treasuries, not government of Ghana. But then, obviously, it is what it is. I would want you guys, to be ambitious, right? Look beyond, the shores of Ghana. There are, a world of opportunities out there, right? If I were in the position you guys are in today, trust me, if it means, sacrificing, 8 months of my life to score, 800 in a JMAT, to get, into a very good Ivy League university, right? I will do it. And you know, once, you go through the path, of course, with your CFA, right? There would be, a world of opportunity for you. Story, I attended, college with one very, good friend of mine. Smart. He was more ambitious than me. He did his national service as Cowbank, right? After his national service, wrote the JMAT, made a very good score, got a scholarship to MIT. Today, he's having a very good, career out there. Obviously, I would love to retain you over here. I work at Access. I wish, Charlie, there was resources to employ you, but I'm sorry, there's no resource to employ you. That's not to discourage you, right? But I think, the world, is your oyster. There's so much opportunities out there. And when, you have a little bit of ambition, right? You can excel. So we are very, very happy having you on board. The feedback we've received is, we started the competition too late. Next season, we promise, to work on ourselves. And then at least, before we allocate you mentors, the subject company, we believe we can announce it, early so you can start, your research to take, this, a notch, higher. So we are happy for you participating, and congrats to the team, that won. I have Nabayas. I thought we shouldn't, say that, but I didn't want Ashesi to win. I honestly didn't want Ashesi to win. But it is what it is. I'm happy I wasn't a judge. I'm happy I wasn't a grader. So congrats. And congrats to my alma mater, University of Ghana. Soft spot for you, Charlie. You guys, did great. Congrats, to Ashesi team. Is it team A or team B? Ashesi. And then congrats to UPSA, right? Even though I was, their mentor, I had my soft spot for University of Ghana, right? So, you guys, did great, and oh, and KNUST. I loved your presentation. And the potential is there, right? The potential, is there. I hope, next, season, you would all participate and then encourage, your juniors, to put in the work to take I mean, to your various alma maters. But we are very thankful and grateful that you took part in this year's season. Thank you.
Okay, thank you very much, Mr. President. And I think once we are done with the closing remarks, I would like to say thank you all to, first of all, to our partners and sponsors, Cowbank. I would like to say a big thank you to the graders and also to the judges around. A big thank you to the faculty advisors. That have been holding us together and the teams together for all this while. I would like to also say a very big thank you to the participating teams. I know that some will feel a bit disappointed. That's the AI for you, you know. Sometimes you can't just predict it. You know, you can't just predict it. Listen, I mean, for example, my KUST, you did very well. I mean, everybody knows. They did extremely well, you know. Yeah. So I had to, if you remember, move and go and cross-check the results again. And I told you, like, it's 50% written and it's 50% graded. So basically, what you wrote were graded by separate people, not the people here. And the marks are there. And then the presentation too is different. So we are not giving results for only the presentation that was put out today. It was actually a weighted average of the two. Do you understand? And the scores are very, like, 1, 2, just some few marks next to each other. It's very, so that's why that caused, so I went in there to cross-check that, hey, AI, Charlie, even though you are AI, it will be human beings, so you cannot be distracted or mental, you know. So basically that is it. I mean, I needed to put that across, right? I needed to put that. And if you honestly saw me leaving here, leaving this stage for some a while to go and cross-check, and even you saw a free bringing the laptop for us to cross-check and see and know that we are doing the right. And then in fact, when we went there, we realized that yes, it's a 50-50 waiting. So please, that is what it is. That means that you did a very good work, you did a very good show, but then the rating too, there might be other areas, the graders think that, hey, once you go to the next stage, they will look at your weight is the same thing before you come in. So if your rating, there was a fundamental flaw in it, that cannot take you there. That is it. So, and also the UPSA team, to University of Ghana, yeah, you two are AI, algorithm, you know. So thank you all very, very much. Don't be discouraged, like I told you. It's like the CFA, everything you learn here, everything you do here is like the CFA exam. You know, I had to rewrite one level 3 times. You know, you fail. So the last one that I was failing in peace. Emmanuel Jem went to the stage and said, oh, it was so cool, you know. so I tell you, CFA will humble you, you know. It cuts you to size. But the beauty is that once you are humble, there's a lot. You see, it's in humility. Before you jump like a spring, before it can extend its width and go the height that it's meant to be, it needs to be suppressed. That's the humility aspect of it. So don't feel perturbed, don't feel down. Right? It's an opportunity to go back, revise your research report, look at what you can do, and read through yourself next year. And I know that the outcome, maybe Nana's expected outcome of his team, UG winning next year, might come on, who knows? Yeah. So thank you very much. At this point in time, you can take pictures with almost everyone. Make sure you take pictures because next time you see them, maybe they will be finance ministers, or you cannot even get an opportunity. Okay, thank you very much. Okay. Okay, so we are having